sake. So like I said, it's not different from what most of the participants already know, but just for us to have a little tweak, maybe there'll be one or two things you will learn afresh, or possibly a refresher of what you have already known. So as part of the outline for this topic, we will be looking at understanding and explaining the purpose of depreciation, preparing and maintaining fixed asset register. What exactly is fixed asset register? Maybe I should even pause there. What is fixed asset register, and how is it different from fixed asset schedule? Anyone?
Okay. Good evening, sir. Okay, sorry.
Good evening, you have the floor.
Okay, so a fixed asset register is just like a document showing a list of all the assets that an organization owns and controls, while a fixed asset schedule shows the movements between assets. That's the cost, the depreciation, and the balance at every year end. That's what the fixed asset schedule contains. That's just the difference.
Okay, any other view from any other person? Thank you, Idris.
Good evening, sir.
Yes, sir.
Good evening.
To my best of knowledge, sir, the fixed asset register is the list of asset register that shows the assets type or grouping. It also shows the breakdown of the depreciation and the yes. So and whereby the fixed asset schedule is just a sub or the fixed asset register. That's sir.
Okay, thank you. Any other view?
Good evening, sir.
Evening, Mr. Raymond.
Yes, sir. A fixed asset register is a register that shows all the classes of asset, their allocation. That means where you can find them, where they are being kept, their attacking, and everything. Why the fixed asset schedule is a schedule that also shows the classes of the asset and depreciation charge and their carrying value at the end of every year.
Okay. So as part of the salient, thank you everyone for all your contribution. As part of the salient points that need to be noted in the course of this class, when an asset is purchased and VAT is charged on that asset, how is it to be accounted for? How is the VAT to be accounted for, including the cost, other cost of the assets, and what are the relevant accounting entries? Anyone?
Okay, sir, let me try.
Okay, you have the floor.
Okay, when asset is purchased, you are going to debit the asset with the amount of money paid, and you credit the amount of VAT payable.
Let me put the question in perspective and and attribute values to it.
Okay, sir.
Assuming you have an asset that costs, maybe office equipment that costs 20 million naira.
Yes, sir.
assuming the VAT is at what do you call it now? 7.5%.
Yes.
7.5% of 20 million naira will be worth, or let's even say 10 million naira is the cost of the asset. 7.5% of 10 million naira will be 750,000. Am I right?
Yes, yes, sir.
Okay. So how do you post this exactly?
Okay. The cost of the asset will be 925,000 naira. That will be debited.
No. The original value before VAT is 10 million.
Okay.
The VAT is 750. Invoice
Yes.
value is 10.750.
Okay. Okay, so like I was saying, you are going to debit the total cost of the asset, 10.750 will be debited. And the corresponding entry will be, you credit the VAT payable with 750,000 naira. So I think I'll
Listen
stop.
to you.
I'll stop here for now.
Okay, thank you. Any other contributions? Abdullahi on the chat box is saying debit the asset with 10 million and 750,000 and credit the vendor with same amount, I presume. Okay, any other contribution, please? For the benefit of those who are just joining us, there are quite a number of topical issues around accounting for PPE and the incidental depreciation on it. So we have put up a case study that an asset has just been acquired with a value of 10 million before VAT. And a VAT, assuming it's at 7.5%, VAT on that is 750,000. How will this transaction be accounted for?
Okay. Okay. Let me do that. If I'm assuming that the VAT is irrecoverable. So
You're assuming that what?
The VAT is irrecoverable. That means we cannot get back the VAT in the future. We can't this VAT input and output issue.
Okay, so what is the premise of your assumption if you're making that assumption?
And because we're not selling the assets, we're like a final consumer.
That is not enough. One of those values that we are expecting every member of this training to imbibe is any position you are taking on any professional issue, you should have either a legal basis for it or any standard basis. So if I put it to you, what premise it's your assumption?
Well, I didn't really have much premise about or solid premise to back it up.
Okay, go ahead.
Okay.
That's good.
So I would capitalize or amortize all the VAT. So that would be both VAT and the cost of the asset will be added together, and which I will debit the assets and credit either bank or cash or account receivable.
Okay. No, not account receivable.
Sorry,
account payable.
Bank or cash rather.
Okay. All right. So
or account payable. Yeah.
First thing first, when we talk about PPE, the underlying accounting standard that supports that is IAS 16. And the standard is very clear. The standard provides that every cost incidental to the purchase of the assets, to put it to the point that that asset is in a point of business use, right? That cost, all those costs should be accumulated together and capitalized. That is one of the premise of the decision that position or assumption that Azuka has taken. Azuka, take notes. Then even within the purview of the Value-Added Tax Act, it makes it quite clear that when you incur any VAT on an asset, it cannot be claimed as input. So what the position the law has taken is that that same cost of the VAT on that asset should be capitalized and subject to depreciation or write-off as the case may be. So if you check the position of the law, the tax law, Value-Added Tax Act, and that of the accounting standard, IAS 16, it is not at variance. So these are some of the issues we'll be looking at today, because whatsoever amounts you legitimately or correctly capitalize will have an underlying impact on what your depreciation may be, right? That's first thing. Then second thing, under what circumstance do we use the word depreciation? And under what scenario should we use the word amortization, right? My point is depreciation the same thing with amortization? If yes, why? If no, what are the difference? Question to everyone.
Okay.
Yeah,
For
they are not the
the
same.
on the issue of depreciation and amortization, sir, they don't actually mean the same thing. While depreciation means the allocation of the cost of non-current assets over its useful life, amortization actually means the allocation of the cost of intangible assets over its useful life. So there are two different things. Depreciation and amortization are used in two different scenarios. That's for two different classes of assets, non-current assets and intangible assets. I don't know if it's clear enough, sir.
Yeah, thank you. Any other view?
Yes, sir.
Okay, you have the floor.
So the both mean the same thing, just that depreciation is for tangible asset, that is not current asset, while amortization is for intangible asset. But they are both spread over the useful life of the asset.
Oh, no, is there a phone number?
Azuka, want to say something?
I think I go with the first Idris Abubakar. So the intangible asset, we use amortization for that, while the not tangible asset, which also PPE, as in the not current asset, we make use of depreciation.
Okay, there is a term that's an expression that is common to the three contributions, and that is intangible. What is the standard on intangible assets?
IAS 38.
IAS 38, okay. So for point of clarity, the concept in context, depreciation and amortization are actually they actually means the same thing, but in terms of register, they are used for two different categories of assets, right? Why depreciation relates to tangible assets, for example, PPE, amortization relates to intangible assets, right? Like goodwill, patent right, trademark, and the likes, right? but both is actually recognizing the wear and tear or the loss or the usage in the value of the underlying asset, right? So these are part of the things we'll be looking at as we go on with this topic. So preparing and maintaining fixed asset register, maintaining and preparing the fixed asset schedule, calculating the charge for depreciation using straight line and reducing balance method. According to IAS 16, there are quite a number of methods that the standard actually recognize, which can be used in accounting for depreciation on PPE. In the course of this class, we'll be looking at virtually every one of them, and we'll also unravel the thinking or the notion around the choice of any preferred method. What are the common assumptions that you should have before you could say, oh, I want to use the sum of the year digit method as a method of depreciation, or you want to use the machine hour method as a method of depreciation, or even the very common one, straight line or reducing balance. We'll be looking at that in the course of the class. Generally, and what we've learned in the course of our schooling days and in preparing for exams is that organizations just make a choice, right? But in practice, we get to know that there are common understanding that should be in place before you make that decision. We'll be looking at that in the course of this class. Identifying the circumstance where different method of depreciation would be appropriate. So if you say you want to use straight line, is it appropriate for the circumstance at hand? If we want to use reducing balance, what peculiarity must be on board on the assets under consideration before that very set of method can actually fly. If you want to use machine hour method, if you want to use revaluation method, under what instances can each of these methods could be more appropriate? We'll be looking at that in the course of this class. All right. Then we'll also consider illustration on how depreciation expenses and accumulated depreciation are accounted for in the various ledgers or accounts. How to calculate depreciation on a revalued non-current assets, including the transfer of excess depreciation between the revaluation of surplus and retained earnings. There is a very cogent clarity that will be made in the course of this class with regards to the position of IAS 16 when an asset is being revalued. Say, for example, you have a PPE, say office fixtures, right? And the office fixtures was actually purchased for, say, 1 million naira. With the advent of loss in the value of naira and the appreciation of dollars, assuming that we tend to revalue the cost of that fixtures if you had wanted to install it today. Assuming also that the value has appreciated by extra 750,000. So the current value of the assets is now 1.750 as opposed to 1 million, right? Given that scenario, how do we account for the revaluation gain? Because it's just a notional gain. What is the position of the standard on that? Then any submissions or position you took or you take on the underlying gain will also have impact on the depreciation when you are then depreciating the original cost of the asset as well as the revalued or the surplus on the assets. Let me get a public view, the participant view on this. Given my scenario, how do you think the revaluation gain should be recognized? And when that asset is then depreciated, how would we account for it? Let me get your view. Who has something to say on that? Jimo, do you have anything to say? Khadija, Adetunji, Azuka, you want to say something? You have the floor.
Okay, sir. Let me try some. The revaluation gain. I think this I will do it then, if I could remember. So if there's a
I think you're a bit
gain,
far from your mouthpiece. Can you speak to it a little bit closer?
I should move closer.
Yeah, exactly.
Can you hear me now?
Yeah, very better.
Okay, yeah, it will affect two accounts. It will affect the revaluation account, which is statement of equity, and also the comprehensive. Forgetting this one. Income statement and other comprehensive income. Okay. We will debit. Sorry. Let me calm down a little bit. Let me come back. I'll stop later. Let me think again. Let me compose.
Can I try, sir?
Okay, try. Have the floor. Adetunji, right?
Yes, sir.
Adetunji from
Oshodi, Lagos.
Okay, Lagos. Okay, good. You
Yes,
have the
sir.
floor.
So for that, we credit the revaluation surplus and debit the property, plant, and equipment with the amount. I don't really get the evaluation amount, sir.
750,000 over 1 million.
750. Okay, the revaluation surplus will be 250. So
No, the revaluation surplus is actually 750,000. The
okay,
original
okay,
cost
sir.
of the asset is 1 million.
So we will credit revaluation surplus in the statement of equity through the other comprehensive income, and we debit the assets with the 750,000. So altogether we have like 1,750,000 for the asset, and the revaluation surplus will be 750,000.
Okay, let me take you there. Assuming we are depreciating the assets over 6 years, or assuming that we are charging 250,000 as let's say we are depreciating the asset over 7 years, right? How do we account for the depreciation? Khadija, I'm coming to you.
Okay, in terms of depreciation, the depreciation will only affect the initial cost. As the cost now is 1 million. The cost is 1 million. So assuming the depreciation is like 150,000.
Go ahead.
So assuming the depreciation is 150,000, the cost as at the carrying amount as at the end of the year will be 850,000. So we now add the revaluation surplus on it.
Distracting us. Go ahead, my brother.
So I said the cost is 1 million. The initial cost is 1 million, less depreciation of 150,000. So we have 850 as the cost at the end of the year, and the revaluation surplus of 750 will be added to the 850. So that will give us a 1,600,000. So that will be the carrying amount.
Okay, before that, I'll get back to you. Let's get another view. Any other view?
Yes, sir.
Yes, sir. Okay.
Oh, go on.
Okay, so I wanted to talk about the first question that was with assets, with valuation surplus. I feel like we'll debit the asset account with 750,000 because it's increasing the carrying amount of the asset. Then credit OCI, other comprehensive income with the revaluation gain. Then for the second question, I didn't hear the cost of the asset. I just knew about the revalued amount and the number of years.
Okay, we assume that the number of years is 7 years, and the cost of the asset originally was 1 million with a revalued sum of 750,000. So what would be the treatment to the depreciation on the assets when it is then depreciated?
First question, was the revaluation, that's the revalued amount that was added to the initial cost, was it in that same year, the same year that they bought the asset? That's as the number of years not reduced at all, has it not like used part of its useful life at all?
Okay, very technical question. For simplicity, let's assume that it was almost immediately we bought the assets that the revaluation occurred.
Okay, so for the depreciation, are we using straight line method?
Yes, we assume 7 years across the useful life, yeah.
So the depreciation value will be 250, I think, yeah, 250,000. That's after the cost has been added to the revalued amount. So to the revaluation gain. So the total revalued amount will be 1,750,000. And yeah, if you divide that by 7 years, for that year, the depreciable value is 250,000, and the next carrying amount is 1.5 million.
Where will the depreciation be recognized?
Okay, the depreciation will be reduced from the assets while they are recording it in statement of financial position. And I think, yeah, it will be expensed in the statement of profit and loss account.
Okay, any other view? Thank you, Khadija.
Yes, sir.
So you can see that, okay, Raymond, are you ready? Go ahead.
Yes, mine is a question.
Okay.
What is the tax implication on revaluation of assets?
Hey, Raymond. Okay. Revaluation, or should I answer that, or I give it to everybody to answer? Okay, but maybe because of time, let me just answer that. Revaluations that it's not, revaluation is assumed to be a national gain. So it is presumed that said gain has not been, until when it is eventually disposed, has not been realized. So it is not a taxable income. Do you get that, Raymond?
Yes, sir. Yes, sir.
All right. So this very illustration we have given, it's some of the some of the content of this training. So I will urge you for you to have a clear view to this. Listen very well as we go on. The very last scenario that we'll paint before we go into the body of the training proper, I will still want to leverage on that very asset, as an asset that costs 1 million, which has been revalued for 750,000, giving a current value for 1,750,000. Assuming in the second year, the asset was subject to revaluation again, and this time we have a revaluation loss of 950,000. How will that be accounted for?
I want to try, sir.
You have the floor.
Okay. Since the first revaluation gain was 750,000, so we will debit the other revaluation surplus. Let me just say OCI. lost on revaluation with the 750,000, and the remaining 200,000 will be expense in the P or L.
Okay. Any other view? Any other view?
I actually agree with him when he said, actually I agree with him. Yeah.
So, but the revaluation loss this time is not 750, it's 950.
Yes, it's 950.
So
So
what
it's
then
going to
happens to the remaining 250?
It will be expense in the P or L.
Okay. All right. Well noted. We'll bring up all of these questions and the appropriate response to it towards the end of this section. So let's go straight to the topic. Our objective first is to define what depreciation is and explain why accountants provide for depreciation in financial statements, to understand the rationale for choosing depreciation method and how to calculating depreciation using straight line and the reducing balance method in particular, explain the significance of maintaining a non-current asset register and fixed asset schedule. So understanding and explaining the purpose of depreciation. It is not far-fetched from the fact that businesses, for them to be able to meet the obligatory demands of their customers, there are certain assets that are very crucial to the business activities, depending on the nature of the business. So what then is an asset, right? In a layman's language or words, we can say that expenditure you have incurred in the past to acquiring its resources, which is not meant for resale, but retention for use in the business, believing that as you continue to use these resources in the business, it will attract more economic benefits. So organizations has acquired various resources, such as what we then call the PPE, the building, the computers, the fixtures, and every other gadget necessary for the business use. But what's remained very striking, particularly to non-accountants, is they tend to disreckon or only write off the expenses, the amount with which these assets are acquired in the year of acquisition. But accountants' view is saying, no, these assets are to be used for more than 1 year. So ideally, if you're using the asset for more than 1 year, it does not make accounting sense for you then to recognize the whole of that expenses in the year the expenditure was actually incurred. That being said, accountants now come up with a position that there should be an accounting way of accruing for the portion of that asset that must have been used up in each year of the asset's useful life. That's accounting sense of accruing for what has been used up of the assets is then what we call depreciation, right? But we know that depreciation, as the case may be, or that write-off, as the case may be, may relate to assets that we can see, we can touch, which we then call the property, plant, and equipment. Sometimes, given a much more advanced scenario, there are categories of assets that we may call investment property, right? But there are also certain resources that we have incurred costs on, but we don't see them. But we know and we are convinced that they attract economic benefit to us in future. These things, because we don't see them, but we know it adds value to us in future, or our customers are likely patronizing us because of that presumed cost that we have incurred in developing that notional value. Those set of resources are then called intangible. Intangible because we can't see them, but we know they exist, right? So this set of intangible are also assets on their own, right? Examples of what qualifies as intangible is what we call goodwill. Another name, another word or example could be patent right? Another one could be trademark. All these costs incurred in developing these notional resources brings us economic benefit by virtue of the contribution they made in the business process, or how they were able to differentiate our products from other competitors' products. So when you are then using up this value, we assume that this value incurred on this intangible asset also erodes as time passes by. So that particular set of costs incurred on these resources too are also expected to be subject to wear and tear. But when we are subjecting it to wear and tear, we don't call it depreciation, because depreciation relates tangibly to, relates mainly to tangible items. Raymond, thank you. Raymond has also given to us that a typical example of intangible is software. Very good, thank you very much. While the write-off on this intangible, Wahoo, Ezekiel, please mute your mic. Ezekiel, please mute your mic. All right. While the write-off on this intangible is what we call amortization, right? We need to take note of this. But at this junction, I need to point out another accounting terminology, and let's see whether there are differences between what we have explained thus far and this particular terminology. But before then, somebody says, can intangible assets and incorporeal property be used interchangeably? Yeah, not every intangible would qualify as incorporeal properties, but of course, it's an example of intangible assets. So that being said, what is the correlation? Having cleared the fact that in context, depreciation and amortization means the same thing, but we use it for different class of assets. Having said that, how is depreciation or amortization different from what we call impairments? Are they the same?
No, sir.
All right, with reasons.
Impairment is a reduction in the value of asset.
Okay. Yeah.
The reason.
Yeah, you're fine. So that is a very cogent fact. Look at it. Impairments relate to what is the cost of this asset today vis-a-vis the other economic factors that we use in measuring the cost of that asset with what it's actually economically worth when we are to acquire that asset in an arm's length transactional market, right? But on the side of depreciation and amortization, we are not comparing the assets or the cost we have incurred on that asset with any market variable. Rather, we are just saying that this asset, we have acquired it for XYZ. And because we have been using it for business purpose, so we presumably assumed that there are portion of the total value of the assets that must have been used up because of the passage of time, right? So that is in context, the differences between the two. And very clear, there are distinct standards that actually addresses each of these accounting terminologies. While within the purview of the current substantive standard we have, IAS 16 relates to PPE, by extension addressing the provisions relating to depreciation. IAS 38 relates to intangible assets, and then technically make some relevant provisions for amortization. But a different a different standard actually addresses the concerns of impairment. That is what we call IAS 36, impairment of assets, right? It is very good for us to have clear understanding about what each of these means and the applicability of each of these scenarios. It is worthy to note that capital expenditures such as building, plants, fixtures, and fittings do normally last for more than 1 year or more than one accounting year. Due to the usage with the passage of time, this asset tends to deteriorate. So one of the various reasons while assets are either depreciated or amortized is because of deterioration. What are the other reasons that could make us depreciate an asset? What are the other reasons? Aside the deterioration arising from usage, what are the other reasons that could make us depreciate an asset? Obsolescence, very good. Obsolescence, very good. As a result of this deterioration or obsolescence or other factors that could account or attract depreciation, there is therefore the need to recognize the loss in the value of the non-current asset, as the case may be, or intangible assets in some other cases. So when we are doing that, what we then say is that we are, Koforo, you need to clear this. What do you mean by sales of assets? Are you in a place where you can enable your mic to justify your contributions? Or we should go ahead? Oh, she's not saying anything. Okay. I wanted to clear, I got a contribution on the chat box saying that sales of assets, is that one of the reasons why we could depreciate an asset? I need you to clear that. Okay, we should go ahead. So if this is not done, that is depreciation of those assets, the value of the non-current asset in the statement of financial position will be incorrectly stated. So if we don't depreciate the asset that has been used in generating income or in the day-to-day affairs of the business, then we will have eventually succeeded in portraying a wrong picture of the financial position of an asset. But at what point do we then recognize assets that have been acquired many years ago or periods before the date of commencement of business? For accounting purpose, which dates will you then recognize that asset that we have acquired many years ago before the commencement of business was put to economic use at a later date? When do we then assume that we have acquired the asset and the asset is to be put to economic use? Because of time, let me quickly clear that. It is possible for you to have assets that have been acquired many years or decades before they eventually put to economic use. the position of the standard is very clear. You can subject that very asset to impairment to be sure whether before the date we are putting it to economic use, it has not materially been impaired. If you do that and it has not been materially impaired, you will, even though the asset has been acquired prior to that date commencement of business, it will be presumed that that asset is acquired on the date that the business commences. So depreciation will not have been accrued before that day, but from the date that the asset is put to business use, then thereafter. Please take note of that. This process of recognizing the loss in the value of the assets as a result of the usage or using the asset is called depreciation. It is different from the loss that accrue because the asset does not then worth or merit or equate its market value, right? Do we say an asset has impaired if the cost of the asset is, say, 10 million naira and the market value as of today is 10.5? Do we say the asset has impaired? I need a response to that. When the market value of an asset is higher than the cost of that asset, do we say it has impaired? No, exactly.
No, sir.
No, exactly. Okay, but it will have been presumed to have been impaired if the net realizable value from that very asset is then less than what the book value of that asset then is. That is when we say it has impaired. So by illustration, we are saying an asset on the book, after taking cognizance of every economic effect of the business arising from the business use, we say the asset worth 8 million naira. But if you want to buy the asset today, even in a second-hand market, right, it's not more than 6.5. So technically, that sort of asset is then said to have been impaired. So we also need to put in perspective which should rank first. If an asset has a carrying value of 8 million, but in that particular year it has been impaired by 1.5, which should you recognize first? Are you to recognize depreciation before impairment or impairment after depreciation? Which should come first? Or what value will you actually be depreciating? Is it the 6.5 or the 8 million?
Okay, so I think the impairment should actually come first, so that we would actually get the real economic value now of that asset before we apply depreciation. So we'd actually be applying, depreciation now on the 6 million.
Exactly. So please, in the course of your work, whether it's your employer or your client, take cognizance of this. And for those who are in practice acting in the capacity of an auditor, you may recommend an asset that have shown the indicators of being impaired be appraised for that purpose only where there will be valuable economic benefits added. Otherwise, even though we presume that impairments may be in perspective, we may not test the assets for impairment. So this loss of value is called depreciation, involves physical deterioration of the assets. So what are the things that could bring about depreciation now? We talk about the wear and tear, which is primarily because of the passage of time and use of the asset. We talk about rust, rot, and decay of the asset. So that is attributable to the assets not being in a good state. That does not necessarily mean that it's not functioning, but it's not as attractive as it used to be. Then another indicator is obsolescence. Obsolescence occurs where you have newer versions of that very asset as compared to the model or the year of invention that of the assets we're using. Then the standard talks about depreciation. The standard that talks about depreciation is IAS 16. Of course, I've mentioned that before. I defined what a depreciation is and some concept relevant to depreciation. Some of these concepts are depreciation itself, which is representing portion, the presumable portion of that asset that is attributable to usage for business purpose. It also talks about the depreciable amounts. When the value of an asset, when the cost of an asset is 3 million, say for example, and that asset is expected to be used for 3 years, after which the scrap value will be 0. Then we say the depreciable amount is the original cost minus the scrap value, which will then give you 3 million. So, but if in another scenario, you have an asset to be used for 3 years that originally cost 3 million, but will be having a scrap value at the end of the 3 years to be 5 million. Then the depreciable amount is the difference between the original cost and the scrap value. In this instance, to then be 2.5. So it is very important for you to take note of the implications of these terminologies, and we make sure that we use them within the right context and notion. Then the third one is residual value. Residual value is what I earlier called the scrap value. So that represents the value the asset is expected to command after the expiration of its useful life, right? While the next one is useful life itself, that is the presumably the number of years that that asset is expected to be used for business purpose. What happens if an asset is expected to be used for, say, 5 years, and after the 5 years, the asset is still in a good and useful business state? What then do we do? The standard is very clear, but there are sense of judgment that the organization can make. One of those line of thought is, if the business still thinks that the asset is not obsolete and it can actually perform up to expectation required for the state of the business, they may subject that very asset to revaluations, right? Trying to reattribute a reasonable economic value for that asset, even though the original cost has been fully or partly or reasonably written off to its scrap value. So that could then bring about what we call revaluation gain, as the case may be, or revaluation losses. When assets are revalued above its original costs, right, it is expected to be accounted for as an OCI item. That was part of the question I earlier asked. But if you have an asset which originally cost, say, 10 million, but had been impaired to, let's say, 7.5, was subsequently then revalued up to 8.5. There is a revaluation gain of 1 million, right? How will that, or where will that 1 million be recognized? Is it in the income statement or in the OCI? Question to everyone, please. Where will that be recognized? Where will that be recognized?
I think OCI.
So the other comprehensive income.
What do you say?
On the other
OCI.
comprehensive income.
Okay, so please take note of this. IAS 16, and I will advise that after this class, we should go back and read this again. IAS 16 is very clear. It says that when the original asset, cost of an asset, is subject to impairment, that impairment loss should be recognized in the original income statement, not in the OCI. If an which is in my illustration, an asset cost 8 million or 10 million. It has then been impaired to 6.5. 3.5 have been written off that very assets. That loss or impairment loss will not be recognized in the OCI, but in the income statement. If that same asset was then revalued upward, right, but below the original historical costs, that revaluation gain will still not be recognized in OCI. It will still be in the income statement. Why? Because the revaluation is not above the original historical costs. So any form of impairment that occur that reduces the value of an asset below its original value should be recognized in the income statement. But if revaluation upward or downward occurs above the original cost of the asset, it is then to be recognized in the OCI. Take note of that. 1 minute. So please, I'm back. I hope that is well noted. And any question on that before we go on? Any question?
Sorry, please. I didn't really get the revaluation part where you said upward or downward having to do with the original assets and OCI. Please, I want to get the statement again.
Okay. There are two components of the comprehensive income statement. You have the income statement proper, and you have the other comprehensive income. Within the purview of IAS 16, it says that you should recognize the costs of that very assets. Note the cost of the assets. When the asset is revalued upward above the original costs of that very assets, because that is not the primary business objective of the business. Anything above its cost should be recognized in other comprehensive income, right? Any impairment on that asset below the original cost of that asset is within the purview of its primary purpose of being in business, because that cost was originally incurred for the purpose of the business. So losses that should accrue to it to below the original cost relates to the main purpose for which the business has been set up. So it should be recognized within the income statement, not in the other comprehensive income. So coming back to my illustration, if you have an asset that originally cost 10 million, revalued downward, right? The downward review, that impairment loss will be recognized not in OCI, but in the regular income statement. Now, we said in my illustration, revalued to 6.5. Again, there is then some other economic indicators in the subsequent period that makes them to revalue it upward again. But this time is still not above the original costs, right? So that revaluation gain will still be recognized in the income statement, not in the OCI. Things that goes to OCI are things above the original costs, whether reduction or increase, the moment it is still not below the original cost, it will not come to, the moment it is within or above the original cost, it will then be recognized in the OCI. That's my point. Is that noted? And is that clear?
Yes, thank you. Thank you.
All right. So the purpose for depreciation includes the main purpose of depreciation accounting is to account for the cost of the asset in a pattern that matches their decline in value. That is, as the value presumably diminishes as a result of passage of time. Then secondly, depreciation is done to match the expense recognition of an asset to revenue generated by that asset. So that is just in line with the matching concept, and which I said coincided with the thinking of an accountant. A regular non-accountant will say, I acquired these assets, even though it's an asset, even though the item is still there, they will want to match the cost of that asset to the revenue they have made in that year. And we said in accounting it is wrong. Since that asset is to be used for more than 1 year, then the write-off on the cost of that asset should be spread across the useful life of the assets. So when you do that, we are simply acting in line with the matching concepts. Then a fixed assets register, that is now talking about what a fixed asset register is. As the name implies, it is a register that contains a list or the details of that asset in question, and just trying the very relevant of it is for us to be able to locate what is the asset itself, when was it acquired, how many are in terms of quantity, what is the location of the asset, who uses it. These are some of the details that a fixed asset register provides. Unfortunately, no portion of the standard actually gives in explicit terms the components of the fixed asset register. Therefore, various organizations may put the format in various ways. But for simplicity, we expect that it should contain the name of that asset, what is the number of the asset, what is the location of the asset, what is the cost of the asset, how many in terms of quantity. Let me just project a simple design template that I have in use. Confirm if you can see my Excel screen. Can you see my Excel projection? I projected something on Excel. Can you see it? How about now? Can you see it now? Hello? Okay. So when you are designing a fixed asset register, it could be in this form, right? So you have the various headings: serial number, item description, location, user, dates of purchaser is the year, cost of purchase, quantity, cost. These other details can be there if you so like. It just helps you in being able to track the accurate estimate of the depreciation, and it's also a good basis to actually justify your claim of capital allowance in tax and various components of it when it comes to balancing charge estimates claim and balancing allowance calculations. So for example, we bought and office equipment. Here, where I have this, you will then list what are the various components of the office equipment. Let's say this time we have what we call AC. Say, for example, we could say LG air conditioner. Location, we could say the main office, or we say MD's office, right? Who is the user? MD. What date? Let's say 2020. What is the cost of the asset? Let's say 2 million. I mean 200,000, say for example. How many quantity do we have there? Let's say 1. But that may not be the only quantity of assets, office equipment you have. You could say maybe you also have another Samsung AC, but this time is in the conference room. Say for example, conference room or meeting room. We use it is, we say general use. You can't attribute it to anybody. Let's assume that has been there since 2019, and it is the cost of that very asset is still per unit is this time 350,000, but we have, let's say 3 there, right? So if you look at this, you will see the impact of this in our estimates. So you can also make estimates for other categories of assets, the furniture and fixing, you have a list of them all. Computer and equipment, we have a list of them all. Plant and machinery, you have a list of them all. Motor vehicle, you have a list of them all. So when you use something of this nature, what we then say you are using or you are maintaining is called the fixed assets register. I want to believe this is well understood. Please ask any question you may have on this. Do you have any question on this, or we should go ahead? Okay, so I will assume, since there is no response in that regard, I will assume all that has been explained is well understood, so we can go ahead. All right, so that having been explained, we say a fixed asset register is a catalog of an entity's fixed assets, carrying details such as purchase price, class of the assets, name of the asset, value, date of purchase, new investment, that is the additions to the assets, and the location. It helps the business to maximize the use or utility of the assets, which simply say the use, such as the machinery and the likes. It helps you to also know what exactly in quantity, in location, in simplified terms, where the asset is. This is one of the documents that an asset, a fixed asset manager is expected to maintain to actually guide against asset thefts or misuse, or what we could call misappropriations of assets. So every organization is not expected to just depreciate its assets, but have a register that will show in explicit terms the cost, location, and every other salient fact about the asset. I'm sure for the auditors amongst us, during audit, you definitely will want to reconcile the values or estimates of the PPE as shown on the face of the account with the relevant notes to the various fixed asset register. All right, so that being said, we can go on. The format of fixed asset register varies depending on the need of the entity. So The format, the template I've shown doesn't mean that when you go to various organizations, that is exactly what you will see. You probably will then need to, each organization will then need to rearrange or realign the disclosures therein to suit their own peculiarity. So a business can maintain its register manually if you so choose. So by that, it means that you have a book that you call the fixed asset register, and you update the asset as they are bought using books or computer or using software application to help with the management of fixed assets. These records are updated from time to time by the accountant or bookkeeper. There is no universal acceptable format for how a fixed asset register should be maintained. The extent of details included about each asset will depend primarily on the country's laws and the requirements of the management team. I believe this is clear. Please, if you understand what I've explained thus far, simply indicate I on the chat box. If you indicate, if you understand what we have explained thus far, indicate, or otherwise ask questions. All right, that being said, still on that, the accountant is responsible to maintaining the fixed asset register, which shall contain the following. I've given you a list of them, so we don't need to waste time on this. We can go on. Fixed asset schedule, that is the next one now, which we said in specific terms is different from the fixed asset register. The fixed asset register is just like a memorandum book, right? That shows the details of the asset, location, cost, numbers, and all that. But in the fixed asset schedule, you won't have details like how many items of PPE are included in the total cost of the PPE, right? So the schedule is primarily for the estimation of your depreciation and every other impact on your depreciation estimate, right? The primary essence of that is for us to be able to match the cost of the assets with the accumulated depreciation of the assets as a tool to ascertaining what the carrying value may then be. Let me quickly project something too that could explain what I mean by fixed asset schedule. Don't forget that fixed asset schedule is usually a supplementary part of your financial statement. It's one part of the notes. So you have something of this nature. You have the PPE that have the various category of the assets, right? The total cost that you must have then accumulate in your register as the opening balance will be indicated in the opening row. Any addition during the year will be indicated during the row. It's possible that because of auditors' recommendations, whether internal or external, or reasons best known to the organization, there may be need to reclassify some assets. Maybe they were wrongly categorized earlier. Then there may be some other business decisions resulting in disposing some assets that will then also be indicated. Then the next section is then to showing how to making your depreciation estimates. The opening balance of these, addition during the year, depreciation during the year in respect of assets that have been reclassified, depreciation period to date on assets that have been disposed. Then you have your carrying amount. Your carrying amount at the prior year, that is the previous year, then the carrying amount of the current year. So this is principally or basically what a fixed asset register actually depicts. Please, any question on these notes before we go on? If there is, please indicate. If there is none, please just indicate yes so that we can go on. If there is no question, indicates yes so that we
Sir,
can.
please, can you take it again, please, sir?
What do you say I should take again?
The fixed asset register, this one.
This is not fixed asset register. The one I'm projecting now is fixed asset schedule. This is a fixed asset register, right? The fixed asset register will show the name or this item description, location, user, the year of purchase, and the likes. But if you look at the second one, which is the schedule, it will not show you such details. So say, for example, if I then want to, information you have in the register, in the schedule were actually gotten from the register, right? So if the year, if my reporting year is actually 2020, right? Then this 2019 will have then been my brought forward figure. So this is a typical example of how we will maintain it. Opening balance in this case will then be 1,050,000. Addition during the year, since that is my 2020 that I'm reporting, will be this, right? This is how you maintain that. Then if there are assets that are reclassified, you indicate it. If there are assets that are disposed, of course, you will know that you will have to deduct it. Reclassification of asset. Let's assume out of this 200,000, 100,000 is to be reclassified, or out of this 1,050,000, let's say 450 is to be reclassified to computer and equipment. What I will then need to do under office equipment, I will have shown that reclassification tree in my fixed asset register. So, but on my fixed asset schedule, I will say minus 450,000, right, is being deducted from the office equipment column, coming to the computer and equipment. I would then have the 450,000 there. So this is just to tell you how these fixed assets register and schedules are being managed. Is that clear?
Yes, sir. Thank you, sir.
Yeah, any question again? Please, if there is no question, confirm none so that we can go on. Confirm none on the chat box so that we can go on. All right. So the fixed asset schedule is more of an integral part of an account, of the accounts, just like I explained earlier on, of the company, that includes a list of all the assets in the business. It acts as a source document which shows the closing balance of all fixed assets available at the end of the financial year. It is a detailed document that shows a total quantity of fixed assets in the business, its historical costs, and any purchase or sales of fixed asset during the financial year. Description of the PP of the fixed assets, accumulated depreciation so far, or relating to the fixed assets. But the fixed asset schedule in particular shows three main, in summary, shows three main captions. The costs that is being broken down into the opening, addition, reclassification, disposal. Then accumulated depreciation that shows the opening balance, charge for the year, depreciation element on reclassification, and the one on disposal. Then the carrying value, which is the net book value at the beginning of the period and at the end of the period. Any question? And I've just shown you, just before we get to this slide, the formats of the fixed asset schedule and that of the register. So the essence of a fixed asset schedule includes, this schedule helps the auditor to cross-check the authenticity of figures in the general ledger and physical existence. So that is being corroborated with the schedule and that of the register itself. Then the internal management can as well detect any fraud or manual error with the help of this schedule. Then detailed schedule and disclosures create a positive impact on the shareholders, the creditors, and the investors. That is when you are then making some investment ratios, right? Then the fixed asset schedule also enables the depreciation calculation transparent and comparatively easy. I believe that is very clear because we are comparing one year to the other. Then this schedule is also helpful for forecasting the requirements of fixed asset register. So if you then want to make fixed asset budgets, you can leverage on what is the cost in the past, what is the organization planning to do in the coming period, what portion or addition will be required on the fixed assets. Then talking about the various methods for depreciation. Unfortunately, the standard is very open on this. It actually allows every organization, those who are charged with the responsibility for financial reporting in every organization, to choosing which preferred method of depreciation best suits the assets at hand. So we have the following methods. Straight line method, meaning that you are assuming that the organization received equal economic benefit or value from the asset all through its useful life, which is not very realistic. There are some assets, I don't think there is any asset that all through its useful life, the state of performance will be constant all through. Either of two things are likely to occur. It's either from the earlier usage period, the asset is very functioning, and as the year passes by, it then deteriorates in terms of performance. Or there are some assets that they get to be very effective and more efficient as a result of passage of time and usage. So you then need to look at which one actually corroborates the peculiarity of the asset in making your decisions around this. So you have straight line methods or fixed assets method. That is, in this one, you are charging equal amounts as depreciation all through the useful life. And the thinking is that that asset make equal amounts of economic contribution all through its life. Then the second one is reducing balance method. Reducing balance method means that in the earlier period, the assets serve us better, but as the year passes by, then it then reduces in value, which is very much realistic. Some of the year digits is also similar to what we have explained on reducing balance method. It's just that the only difference between them is that the premise on which, or the parameter on which you use in ascertaining the usage over the years is not the same with the reducing balance method. Then, so you can definitely use reducing balance method or some of the year digits for assets that presumably you think that they serve you better in the earlier period, and as the year passes by, they tend to be less useful, right? Then units of output, this is usually peculiar to productive or production machineries, right? So if the asset has the capacity to produce, say, 100,000 units, then you are then attributing the write-off of its value to giving cognizance of how many outputs were we able to make from the assets in each year. So you are depreciating the assets based on the amount or quantity of output the asset has given to you. Then the next one is revaluation method. You use revaluation method as a form of depreciation when at the end of each period, you have to confirm the realizable or the market value of that asset at the end of each period. So this could give you a moving balances, right? Most of the time, depending on other economic variable, it may either increases over the years, even though you are using the assets. You are then saying that the more you use the asset, the more the asset is increasing in value, or it may be on the reductive path. And it is on this method that the standard is very clear that when the asset is being revalued upward above its cost, then it means we are having additional gain for using the assets. It is not very realistic, but the standard says suspend that gain in what we call other comprehensive income until when the asset is eventually disposed and we actually have the gain as a realized income. But when you revalue the asset and it happens to be negative and the reduction is below the original cost of the asset, then the standard allows that it can be recognized within the income statement itself. Then you have the machine hour. So machine hour is basically paying attention to how many hours you have used the assets before you then depreciate. So if you say you have a plant that has the capacity to be used for, let's say, 100,000 hours, so you will take note of how many hours have you put the plant to economic use, and it is only on that submission you then depreciate the assets. So depletion of units method. This one may be suitable maybe for a mining site, trying to pay attention to what extent has that very asset depleted. So for the purpose of this discussion, we shall only concentrate on straight line method or reducing balance method. But before we go on, I've explained straight line, reducing balance, sum of the year digits, unit of outputs, revaluation, machine arm method, and depletion. Any question on all of this before we go on? Any question on this? If there is no question, just indicate go on so that I can take that as a comfort that we are on the same page. Okay. So basically, the straight line method is saying we are charging the same amount irrespective of the contributions of the assets to the underlying, to the economic activity. We are charging the same value as a wear and tear over the useful life. There are basic terminologies that are peculiar to this. We need to know what the depreciable amount is. We need to know what the annual depreciation is. We need to know what the original cost of the asset is. We need to know what the salvage or residual value is, and we need to know what the useful life is. So the annual depreciation is determined, is that value of depreciation attributable to each year is determined by deducting salvage from the original cost, dividing it by the useful life. Then the depreciable amount is the total of the depreciation expected on the asset over its useful life. So by that one, we mean original cost of the asset minus the salvage. Please take note of all of this. Who is a volunteer to reading this question for us? Any volunteer? Okay, go ahead.
Can I read the question first?
Yeah, go ahead.
Can you
Go
hear me?
ahead.
Okay. So on February 1, 2007, Rwanda Limited purchased a motor vehicle for 250 million. The motor vehicle has an estimated useful life of 5 years with a salvage value of 5 million. Required. Calculate the depreciation charge and accumulated depreciation for each of the years and show the net book value as at the end of 2011 accounting period using the straight line method.
Okay, thank you. So the first question in this one is, what is the depreciable amount? What is the depreciable amount before we even start calculating the annual depreciation charge? What is the depreciable amount?
245 million.
Okay, which is the cost minus the salvage. What is our salvage value?
5 million.
And the cost?
250 million.
Okay, the useful life?
5 years.
5 years, okay, good. So this is now what we have worked out here. So every year we'll be having 49 million. So 2007, you have the carrying value, the annual depreciation accumulated will still be 49. Then carrying amount will be 201. Bring the 201 down here. You have 49, accumulated depreciation will be 98 and 152. Bring it down, that is how it will be going. So the most important thing here is for those in audits, this kind of estimate will form part of your work paper, right? And for the accountants in industry, this will form part of the notes, this will form part of the estimates to your workings, while the summary of this will then be communicated in the fixed asset schedule, which is then a note to your accounts proper. But if you have to look at the reducing balance, this one we are saying that we have a fixed percentage that is applied on the depreciable sum over the useful life, which will then give us higher value of depreciation in the earlier period and lower value of depreciation as the year passes by. So if you look at the thinking around straight line method and reducing balance method, one is saying that we are not paying attention to the variance in the value we get from each of the assets, but in the reducing balance, we are getting value from, we are paying attention to the value we are getting in each of the years. As a result of that, we attribute more or greater depreciation to the earlier period and less as the year passes by. This is a similar question, but the rate of depreciation is different, and that will then give you a different sum. So here we've been given the depreciation rate to be 250 million. So we have 250 million, the depreciation is 20%. Apply 20% of the 250 million, you have 50 million in the first year. Accumulated depreciation is 50, carrying value is 200. You can see it's different from the earlier one. The carrying value is 200, apply 20% on it to give you 40, accumulated 90, and carried amount is 160. Bring this down again, apply 20%, depreciable sum is 232 million. We have accumulated is 122, 128 carrying. Bring it forward again, apply the 20%, you have the 25.6, total to date is 147.6, then you have 102.4. Bring it down again, apply the 20%, you have the 20.4, and accumulated to date is 168.08, and the carrying value is 81.9. So, which the question has provided as the scrap or residual value. Any question thus far? Any question thus far? If there is no question, I need a volunteer to read. Okay, you have the floor.
Accounting for depreciation expense and accumulated depreciation in ledger accounts. After the calculation of the depreciation charge for the year, accountants must record the amount in the books of accounts. It is worthy to note that the process of making allowance for depreciation is matching with revenue, the cost of the non-current asset consumed during the accounting period. It therefore means that depreciation is revenue expenditure, and as such must be recorded in the same manner that accountants record the normal business expenses.
So that is why the annual depreciation is usually recognized in the income statement. So the double entry that we have to pass to recognizing this is debit depreciation expense account and crediting allowance for depreciation. That is the accumulated depreciation, right? That is to recognize the depreciation charge. Then when you then want to prepare your final account, that depreciation expense is for one of the expense in the statement of profit or loss. Then the credit to that, the credit entry that zeroize depreciation expense, so that in your expense account, you won't be having a carry forward balance, right? So that is why that is done. But where you need to pay attention to this is where where an underlying asset has been revalued above the original costs, and such asset is then depreciated. You need to pay attention to the fact that depreciation above the original cost of the assets, that is, depreciation other than what is attributable to the original cost of the assets, should not be recognized in the income statements, right? It's only attributable to the excess of the surplus that should be recognized above. Otherwise, what you would then have written off as depreciation over the useful lives of the asset would then be above its costs, which in context is not ideal. So when an asset has been revalued above its original costs, and such asset is then subject to depreciation, it is important that you need to separate the component of the depreciation that relates to the original cost and the component of the depreciation that relates to the revaluation, which will then be recognized in either, in the statement of comprehensive income, statement of profit or loss and the OCI respectively. Please, I want to assume that that is well noted, but if not, please ask questions before we go ahead. If there is no question, can you indicate yes? Are we all together? Okay. So volunteers are taking this question, taking this slide for us. Any volunteer, please?
Illustration. Can I read it?
Yeah, go ahead, please. Thank you.
Illustration. On 1st January 2013, YSE Limited purchased equipment for 800,000. It is the policy of the company to depreciate all equipment at 20% per annum. Show for the years ending 31st December 2013, 2014, 2015, 2016, and 2017. A, the equipment account, B, the accumulated depreciation on equipment account, and C, the depreciation expense account.
Okay, so this very one, it's an assignment for everyone. I will expect that before our next class in financial reporting, we would have shared this, this on the group. Please do a screenshot of this before we go on. You are to do the depreciation estimates using both the straight line method and the reducing balance method. Straight line method and reducing balance method. Please confirm if I can move to the next slide. I want to believe you have taken the screenshot so that you'll be able to practice the question and share much later on. Okay. So calculating depreciation on the revalued non-current assets. Basic calculation process of depreciation remains unchanged between the revaluation model and the cost model. Under the cost model, depreciation is calculated on the basis of the cost less residual value over the useful life of the asset, which we have explained just now. Over the revaluation model, under the revaluation model, depreciation is calculated on the basis of the revalued amount less the residual value over the remaining useful life. So you want to use that as a tool to ascertaining, are you having a revaluation gain over each period or otherwise? Under both models, depreciation for the period is charged to the profit or loss, except where it is then attributable to the revaluation gain. Please take note of that. However, there is one additional step that the entity may take while calculating depreciation of the revaluation surplus. Entity may then transfer from the surplus account to retained earnings excess of depreciation on depreciation at the end of the period, which still corroborates what I've explained earlier on. So it's either you are taking the first approach, splitting the revaluation, right? I mean, splitting the depreciation into two. The one that relates to the original cost recognizes in the original cost. The one that relates to the revaluation surplus recognizes in the OCI. But you know that every item of the OCI should then appear in your statement of changes in equity. So depreciation of the surplus will then be deducted in the statement of changes in equity. Please take note. This is an area that most people just neglect or overhaul. I want to believe that this is one of the main value addition in this topic, however simple or common it may be. So excess depreciation is simply the difference between the depreciation charge calculated on the revalued amount less the depreciation charge on the historical cost. So please take note of that. So this is just an intro to the main other topic that we'll be looking at in our next topic. As far as this topic is concerned, please take note. We've explained and addressed some very salient issue where you incur VAT or any costs in putting an asset to a usable state for the very first time. VAT is, input VAT is not claimed on an asset, right? You have to capitalize that and depreciate it over the useful life. Take note of that. When asset is being subject to disposal, right? It is also liable to VAT and CGT as the case may be, right? But take note of that is that when that transaction will definitely have the tax implication and the accounting implication. My second question, which is an assignment to you, is on that, please, I want to believe everybody is taking note of this question. Under what instance will assets disposed will attract CGT? Under what instance will an asset disposed will attract CGT? I want to believe everybody had the question. Under what instance you dispose an asset, under what instance will it attract capital gain tax? So I need everyone to be able to attend that. Let's keep the platform very engaging immediately after this class. The discussion should go on so that those who are not even in this class can see or have an insight of part of the things we have discussed. Then I also explain instances relating to depreciation charge on asset that has not been revalued. All the depreciation charge will go to the income statement. But when the depreciation charge relates to assets that have been revalued, there is need for you to split this and recognize part in the income statement and the remaining part in the OCI. But remember that that is also to be adjusted on the SOCI. You are adjusting the depreciation elements relating to the capital gain, to the revaluation surplus on the revaluation surplus balance. So that being said, I want to believe little or more value have been added to what you have also known before on this standard. Point of reference, point of very important reference is IAS 16. Try to revisit this and also refresh your understanding of what the standard says, how what should be treated, how is to be treated. I will also expect that you will revisit IAS 36. What is the position of the standard on that, and how does it relate to accounting for intangibles? Then another very important standard that we have also related this topic to is IAS 36. That is the intangibles. That is the impairment of assets. Then the last one, what is the standard on fair value measurement? What is the standard on fair value measurement? Hello, what is the standard on fair value measurement? What is the standard on fair value measurement? Don't tell me you don't know. Khadija. Abdullahi, Elizabeth. Ezekiel. What is the standard on fair value measurement? Jumoke, Olamide, Raliat. Nobody is talking.
IFRS 13.
Khadija let you. Or who spoke?
I was the one.
You went to check it, Abi?
Yes, I didn't remember, and everybody didn't know, so I went to check.
So very importantly, create time before the next class to actually revisit some of these standards. Don't forget one of our main objectives of this mentorship. We cannot have all the time to take you through all of the salient topics, but the topics where we're looking at should give you an eye-opener to those areas of the standards as far as this topic, this course is concerned, that you need to quickly on your own go and revisit. And when you have areas of confusions or areas you need clarification, throw up the question on the group. Let everybody now give their various opinion about this. So that's where we're going to draw the curtain today. I believe in our own little way, we've been able to open your eyes to something new. And I want to thank you for the time you have taken out of your busy schedules to attending this today. keep on the good news. Let everybody who is registered on this for this purpose, but who have not been attending, let them know how much they have been missing. And I'm also expecting that you will all follow us on our various social media handles and propagate the good news about KCP. I wish you the very best. Any question before we wrap it all up? Any question?
Good evening, sir.
Mr. Raymond.
Sir, good evening.
Good evening, sir.
Yes. Sir, the earlier question you asked about the postings, I want you to please answer the question.
Okay, remind me the question again, please.
Where you said if the cost of a fixed asset is 10 million plus, including the VAT element, 10,750,000 naira. What?
Yeah, I've explained it now. That was what I said, that the position of IAS 16 and the VAT Act is very clear, that the VAT on the asset is to be capitalized. So the cost of the asset and the VAT elements will be debited, right, in the asset account, right? So if the asset had been paid for, then the credit goes to the bank, the same total goes to the bank. If the asset has not been paid for, the same total goes into the payables account. So you are not making any posting to VAT payable or whatever, because we are not expecting to claiming input VAT on asset purchase. Is that clear?
Okay. Yes, sir. Yes, sir.
Yeah. Any
Thank
other
you,
question?
sir.
The last class material, I don't think you have shared it. I don't know. I said I will ask.
I'm sure it has been shared. Please confirm. Every member of this group confirm if that is true. I'm sure the last class materials has been shared. Is there any member who has received the last class material? Anyone? Oh, it wasn't shared. Is Amina here? Okay. I'm sorry for that. I will take it up with my team and that will be shared this weekend. I'm so sorry. I thought it has been shared. I'm so sorry for that.
Thank you, sir.
All right. Thank you too. So any other question before we wrap it up? Okay, so if there is no question, I want to sincerely appreciate you for your time. And I also want to call out, is Yahaya here? Yahaya, are you around today? Ezekiel, is Ezekiel here?
Yes, sir.
Ezekiel, are you in transit or you are in the house?
Yes, I'm on transit, sir.
Oh, okay, so Ezekiel and Yahaya sent me a cake during my birthday. I want to say special thank you to you and everybody help me appreciate them. Thank you so much. And for every other person that shares a lot of messages around during my birthday, I want to say a big thank you to you. I sincerely appreciate it. I don't believe I'm doing anything for anybody. I believe whatsoever we are doing is even for whatsoever we are doing as a firm is for ourselves. And the better you become, the better for me, because I think one of the ways we can actually rebrand our profession and make people respect us the more is doing what we are doing, right? So thank you, everyone. Thank you so much. I really appreciate the Abuja caucus. Thank you. The Lagos caucus. Thank you. The Badon caucus. I want to say a big thank you to you. Thank you so much. Hope to see you tomorrow, I guess. The next class should be tomorrow. So hope to see you tomorrow. Thank you. Thank you. Enjoy the rest of the night.
Thank you.
Hello, sorry, I also forgot to tell you that somebody also sent me credits during my birthday. I've forgotten the person's name. Thank you. Thank you, everyone, for everything you've done. I really appreciate it.